And when it comes to trading in stocks, you do it through what is called stock order. You would mandate your broker to sell or to buy stocks for you based on the order type you want to employ. And so this video is giving us a guide as it relates to the right stock orders you will employ as an investor. So you have different kind of orders with different advantage and disadvantages. Number one is what is called a market order. Market order. So market order is an order to buy or sell, a stock immediately at the current market price. When you key in a market order, that stocks, could be sold or bought at the prevailing market price. So it is when did you use this particular kind of order? It is best for quick transaction when price is less a concern than speed of execution. You want to sell your stock almost in a hurry. You don't bother about the price. You just want to dispose. You just want to buy or sell. You could order. You could institute a market order, and the advantage here is immediate execution. It could be executed immediately. And what is the disadvantage? The price may vary from what you expect due to market fluctuation. The market varies as much as a couple of percentage, and it's very important. Okay, so when I started investing in those days, many years, I used to go in for market order. Just sell whichever price doesn't really is irrelevant. Just sell or just buy at whichever price. you know so number two is limit order. This is the one I employ nowadays. I employ this a lot since I started online investing. I use limit orders all the time. So it's an order to buy or sell a stock at a specific price, or even better, that is it, at a specific price, and if possible at a better price. So it is used when you want to control the price you are willing to pay if you are buying, and the price you are willing to receive if you are selling. And what is the advantage there? It guarantees price control. It gives you control over your investment, control over the price you buy or sell your investments. All right. And what is the disadvantage, or what are the disadvantages? The order may not be executed if the market price doesn't reach the specified limit. Sometimes you may not be able to get what you want at that price. And so they could get a little. If you cannot get additional shares, you can cancel the order and then impute another price limit. It's very interesting, actually. Very, very interesting. It gives you that particular aura of control, over the price you accept and the price you sell or you buy your investment. Number three is the stop order or the stop loss order. This one is very good for traders. It's an order to buy or sell a stock once it reaches a certain price, known as the stop price. So when the stop price is reached, the stop order becomes a market order. That's it. It becomes a market order. So when do you use this particular order? Is to limit losses or to lock in profits by triggering a sell once the stock hits a specific price. If your stop loss order is let's say $2, let's say $10. Once the stock price, maybe the stock was falling, it fell from maybe maybe $13, $12, $11. Once it gets to $10, the system will dispose your stock so that it will not go below 10. So you are able to like stop your losses at 10, not below 10. It is called stop loss order. So the advantage here is to be able to manage your downside risk during market volatility. When the market is volatile, you can contain your downward risk. And what is the disadvantage here? The order becomes a market order once triggered. So the execution price may differ. Once it is triggered, it becomes a market order. Number 4 is stop limit order. Stop limit order here. What's the definition? It is similar to stop order, but the order becomes a limit order rather than a market order. So in this one, it becomes a limit order. It's no longer, once triggered, it is no longer, it doesn't really change to a market order, but rather it is what it becomes a limit order. So once triggered, the trade will only execute at the limit price or better. That is it. At the limit price or better. Unlike stop loss order, there is no better price. But when it comes to stop limit order, it becomes a limit order and it can be executed even on a better, on a better price to your own advantage. And what is it used for? To avoid market order execution, but still limit losses. And what's the advantage here? It gives price control while protecting from extreme price swing. So you are protected if the market is, it fluctuates widely. You are protected in that regard. What disadvantages here? It may not execute if the stock price doesn't meet the limit. So it may remain unexecutable. You can't execute it once that limit is not reached. That is a very important consideration, in these regards. The other one is trailing stop order. The trailing stop orders here, it's a stop orders that moves when the market price is. It moves with the market price, maintaining, a set distance, either in dollar or percentage from the stock highest price since the order was placed. So it's an order that tends to move with the